Welcome to Unit 2. Today we are diving into national income accounting. We will explore how countries measure their economic health, the difference between real and nominal values, and how money flows through an entire economy. Let's start with the big one, gross domestic product, or GDP. GDP is the total market value of all final goods and services produced within a country's borders during a specific period. It is crucial that we only count final goods to avoid double counting. If we counted the steel used to make a car and then the car itself, we would be counting the steel twice. We also exclude second-hand sales because GDP only measures new production. While GDP looks at geography, gross national product, or GNP, looks at ownership. GDP measures everything produced within a country's borders, even if a foreign company made it. GNP, on the other hand, measures production by a country's citizens and firms, no matter where in the world they are operating. To find GNP, you take GDP and add net income from abroad. There are three ways to measure GDP. The first is the expenditure method, which adds up all the spending in the economy. The formula is C plus I plus G plus X minus M. That represents household consumption, business investment, government purchases, and net exports. Notice that government transfer payments, like pensions, are not included here because they are not payments for current goods or services. The second way to measure GDP is the income method. Instead of looking at who is buying things, we look at who is earning income. We add up wages, interest, rental income, and profits. To get the final market price GDP, we also have to add indirect taxes like sales tax, subtract government subsidies, and add back depreciation, which accounts for the wear and tear on capital goods. The third method is the value-added approach. Here, we sum up the value added at each stage of production. For example, a farmer sells cotton for 10. A thread maker turns it into thread worth 20, adding 10 in value. This continues until the final jeans are sold for 50. If we just add up the value created at each step, it perfectly equals the final retail price of the jeans. Now, what happens if prices go up, but we do not actually produce more goods? Nominal GDP would rise, making us think the economy grew. That is why we need real GDP. Nominal GDP uses current prices, so it is affected by inflation. Real GDP uses constant prices from a base year, stripping away inflation so we can see the true change in the actual quantity of goods produced. Because we have both nominal and real GDP, we can use them to measure inflation across the entire economy. This metric is called the GDP deflator. By dividing nominal GDP by real GDP and multiplying by 100, we get an index that shows how much prices have changed relative to our base year. In this example, a deflator of 240 means prices have more than doubled since the base year. GDP is not the only metric we use. If we take gross national product and subtract depreciation, we get net national product. From there, adjusting for taxes and subsidies gives us national income. We can keep drilling down. Personal income looks at what households actually receive, and disposable personal income is what is left over after paying personal taxes. This is the money people actually have available to spend or save. To understand how all this money moves, economists use the circular flow model. In a simple two-sector model with just households and firms, households provide labor to firms, and firms provide goods to households. Money flows in the opposite direction, as wages and consumer spending. In this simple world, the economy is in equilibrium when the money saved by households equals the money invested by firms. Real economies are more complex. We add the government and the foreign sector to make a four-sector model. Money enters the flow through injections, business investment, government spending, and exports. Money leaves the flow through leakages or withdrawals, savings, taxes, and imports. For the national income to be in equilibrium, total injections must exactly equal total leakages. It is tempting to look at a high GDP and assume everyone in that country is doing well, but GDP has strict limitations as a measure of welfare. It completely ignores unpaid housework, the informal economy, and the value of leisure time. It also does not care about environmental damage. In fact, spending money to clean up an oil spill actually increases GDP. Finally, GDP per capita does not show income inequality. A country can have a high average GDP while most of its citizens live in poverty. When we hear about the economy growing, we are talking about the real GDP growth rate, which is the percentage change in real GDP from one year to the next. When comparing these numbers between different countries, we cannot just rely on standard currency exchange rates because things cost different amounts in different places. Instead, economists use purchasing power parity, or PPP, which uses a common basket of goods to make a fair apples-to-apples comparison. To wrap up Unit 2, remember that GDP is our primary tool for measuring economic output, but it must be carefully calculated to avoid double counting. We can measure it by looking at spending, income, or value added. Always look at real GDP to account for inflation. Understand how money circulates through injections and leakages, and keep in mind that while GDP measures production, it does not always measure human well-being.